Hey guys, this is Richie Garzon. Today, I'm going to be interviewing Bart Valley from Morris Financial Concepts. We're going to talk about the recent rise in the stock market. Bart, how are you doing?
I'm doing great, Richie. Appreciate you having me here with you today and appreciate the opportunity to talk with you.
Absolutely. So let's start with what do you think some of the contributing factors are in the change that we've seen recently?
Yeah, so I guess what we're referencing is the market seems to have gained a little traction. The particular week that we're filming this, it's down a little bit, but really since lows in mid-October or so, the market's been doing reasonably well. So some people are calling it a stock market bounce, perhaps the beginnings of the recovery. We don't know any of that, but it's been up a little bit. But I think it's important to step back for a minute first and recognize where we're coming from. We're coming from a really difficult year for investors
Yeah,
last
absolutely.
a
How
year.
would you say it compares to like rebounds in the past?
Yeah, that's a well, the market drop. Let's talk about that for just a second.
Yeah.
Stock market was certainly down. We all know about that. But also last year, what was a little unusual is the bond market, which is usually the safety piece for portfolios. That
Hmm.
was down. It really had one of its worst years ever. So we can rehash the factors that played into the down markets, but we've got the lingering effects of a global pandemic. We've got high and persistent, stubborn inflation, and certainly
Mm.
the Fed's efforts to address that by rising interest rates. That's what affected markets so negatively last year. So yeah, they're coming back a little bit now, but a lot of that uncertainty is still out there. So one of the things that we have clients ask us is, what's the disconnect, right?
Yeah,
Got a lot of
absolutely.
all the uncertainty kind of still there. Plus, now we've got this, potential debt crisis, debt ceiling crisis, and political brinkmanship around that. So, what gives? How's the stock market kind of going up a little bit when all this uncertainty is still there? And
So when
Richie,
you talk about uncertainty, is market sentiment and is uncertainty part of market sentiment? Is that the same thing?
absolutely, investors do not like uncertainty. The markets do not like uncertainty.
Yeah.
And that's kind of when we're talking about investor sentiment being positive or negative. It's still relatively negative. It's been improving a bit, but again, the uncertainty's still there. But it's been improving, so that's kind of the disconnect. If the economic uncertainty is still there, why does the market seem to be catching, getting a little traction? And what I like to tell clients, because that's a question we get from clients a lot, is, well,
Yeah, as you say it, I'm like, well, tell me the answer to that question because I have
yeah,
it myself.
absolutely. And the answer is that the economy is not the market. The market is not the economy. They are
Mm,
intrinsically linked, but they
yes.
are not the same. And there's lots of times when, so think about it like this analogy I like to use. I borrow from our friends at Dimensional Fund Advisors, that think of the economy, it's a snapshot. It's what's going on right now. Whereas the
Yeah.
market is a movie. It's right now, and it's also many years into the future. So when you're investing in the market, you're investing in long-term growth of all the underlying companies.
Of
So
course.
it's now and many, many years from now. So there's lots of times when the economy might still be struggling, but the market is already on a road to recovery. So, just to throw out a couple of examples, 1980, 2009, 2020, we'll remember from COVID. All those were years where the economy was kind of in its darkest hours, and the market was already well on its way to recovery. So
Oh,
they're not
absolutely. That
always
was
the
so
same.
confusing, especially recently in the middle of the pandemic.
And
I
it
didn't
is. It's
understand what was going
confusing for investors to say, hey, we don't even know what's going on with this pandemic yet.
on.
It's
Hmm.
the middle of March. We're still trying to figure it out. And the market's looking down the road, and it's already on its way to recovery. So I don't know where we are right now, but I just wanted to make that point that you can have positive markets when there's still ongoing economic pain.
Well, are there some indicators right now that this rebound might be sustainable?
Yeah, that's a great question, Richie. And I think again, we know what drives markets in the long run. It's
Hmm.
the growth of all those underlying companies. So when I'm buying the market, I'm buying a little piece of Target and a little piece of Google and
Yeah.
maybe a little piece of Samsung and Toyota. So I'm buying participation in the growth of those companies. So if I believe in all the innovation and ingenuity that those companies bring to the table and their growth over the long run, that's what drives the markets over the long run. In the short run, it's news, it's surprises, and it's investors' reactions to the news. So that's what we've been seeing, over the past kind of 6 months or so. Is I call it a Goldilocks market,
Yeah.
because we went through a period where even good news was bad news, right? So people were, things were hinging on this daily economic news, and
Mm.
if the porridge was a little too hot or a little too cold, or the bed was a little too hard or a little too soft, the markets didn't like it either way, right?
That's
So
so true.
yeah, if good economic news came out, it was
Hmm.
like, oh, the economy's running too hot, the Fed's going to have to continue to raise rates. If bad economic news came out, oh, the Fed's overdone it, they raised rates too far, we're already in a recession.
Mm.
So we couldn't quite get it right. News has been a little more encouraging lately. Again, this week, the markets have been down a little bit, but as news that inflation seems to be moderating a little bit in most measures, there's still some work to do. The labor markets are still running pretty hot. Some other things where we need to do some work, but there's been some more encouraging news, and that might be kind of the first sign that this traction will be there.
Can you talk a little bit about the labor markets running hot? Because intuitively, that doesn't feel right to me. So I'm not really understanding that just as a
Yeah,
layman.
and there's lots of there can be arguments over, depending on what data you're looking at and the labor participation rate and whatnot. But if you look at employment numbers, they're some of the best we've had in a long time, right?
Yeah.
Employment that just came out prior to this week, the employment rate is at a many year low. And the new jobs created have been doing quite well. So a lot of that is in these recovering sectors where we had a lot of people laid off during the pandemic, service sector, consumer discretionary, where maybe people weren't doing as much as they did in normal times. A lot of those jobs coming back have been that growth in employment. So typically when the Fed is trying to cool things down and bring inflation down, part of that cycle is going to be, we're eventually going to see some weakness in the labor markets, and that's how we know it's working, because
Oh,
that
really?
takes away the threat of what we call a wage price spiral, where there's low unemployment and there's kind of a demand supply imbalance, and we see wages going up as well, and that can kind of feed into the inflationary cycle. So we actually, kind of counterintuitively, and it's like I said, we want to see some bad economic news on some fronts to make sure that the Fed is getting the job done and cooling down inflation, which is the big threat over the longer run. And they've made it clear that that's their number one goal, is to bring inflation under check, even if it tips us into a recession.
Yeah,
And
that's a very
we,
interesting
yeah.
stance. I know that it's been done in the past, but as an adult, I've not been through it. So
Yeah, and
I've watched some
these are
YouTube
things
videos about
that
it's how it was done in the past, and that's a very interesting strategy.
yeah, and a lot of this high inflation, higher interest rates, a lot of these things that have affected the economy over the past couple of years, for folks, certainly, under 40 or new things
Hmm.
in their
That's
adult life.
exactly.
Yeah, absolutely.
Yeah, my parents are dealing with this, right?
Yeah,
When I was young, I'm sure it wasn't so
yeah.
fun. So just in general, how government policy and central bank actions really affected the market, and did it help cause this recent rebound? What do you think?
Yeah, so here's what I'd say kind of broadly, whether we're talking about market declines or market recoveries.
Hmm.
The government policy, which we can call fiscal policy, and then the Federal Reserve or central bank policy, which we'll call monetary policy. Those are two factors, and they're important factors in sometimes causing markets to go down, sometimes helping in market recoveries. And we've seen both through this cycle. But they're two factors of many. And the way I like to look at it is, we've kind of been hinging on what the Fed's doing. You see a lot of the news focusing on that, and it's important, but it's one factor. Maybe an oversized factor in the short run to get the market back on its feet and
Yeah.
back towards a more sustainable recovery. But think of it like cake batter. You've got your eggs and you got your flour and you got your sugar and you got your ingredients, mix them together. Once it's mixed together, it's hard to distinguish the individual ingredients. That's kind of the fiscal and the monetary policy. They're two of many factors. They're two of many ingredients that affect the markets. And in the long run, which is what we like to focus on, there's certainly, the Fed funds rate is not the primary factor that affects markets. But in the short run, maybe a little outsized influence.
Well, what can we learn from history, would you say, when we're looking at what's happening today?
Yeah, and that's a great question as well, and that's something that we think is really important, because we tend to get tied up sometimes in the day-to-day news cycle. So we encourage our clients, and certainly we want to, as advisors, step back and say, what does the bigger picture tell us? What does history tell us? And that provides important perspective. So one way to look at it is that the fundamental premise of the stock market, which is what we're talking about here, remains the same. And I use an analogy. Well, we're recording right before Super Bowl weekend, so we can talk about football for a minute.
Yeah.
Football, every game is different, right? Every game plays out differently, but the fundamentals of what typically lead to success in a football game are the same. Execute your blocks, make your tackles, win the turnover battle. Even though every game's different, those fundamentals are the same. And the fundamental of the stock market, kind of what I referenced earlier, where that growth comes from, that's the same. The fundamental premise is free markets, right? Companies are free to pursue profits and make money, and they will, regardless of the state of the world. And so again, we get different questions like, oh, how's going back to the political cycle? That's a big one, because we've got clients across the political spectrum, and I've got friends across the political spectrum that might say, well, if Biden wins or if Trump wins, how does that affect markets, and what does this do? And there's a lot of worry over that, and I try to make the point that it's a small factor, and certainly maybe affects some day-to-day stuff, but in the long run, it doesn't affect the markets. Who's president doesn't have a big impact. And if you think about it again,
That's interesting. Who's president doesn't have a big impact. That's a very
there can be some policy impacts, certainly, and some agenda impacts broadly. But again, go back to what is the market, right? We say the market, and we think about it's its own thing. It's the companies that make the market up. McDonald's doesn't care who the president is, right? Target doesn't care who the president is. They're trying to put out good products and services. Other companies like Google and technology names that are trying to innovate new products, they're going to do that regardless of who the president is, regardless of the state of the world, right? And so it can have some short-term impacts, some of these things, but fundamentally, those things remain when we're talking about longer-term market returns.
Well, what about people that are trying to time the market? I know that there's this concepts of cognitive and hindsight bias. Can we talk about what those are and how that could be risky if you're trying to time the market?
Yeah. So people trying to time the market, I'll say up front, don't do it. It doesn't work over time. A lot of, and it's tempting because how great that would be if we knew when to get out of the market, knew when to get in. Awesome, right? But we can't do it, because again, going back to what drives the market in the short run, it's typically surprises, either positive or negative. So you might guess right a couple of times, but you got to guess right a lot to be able to do that. And anytime you try to market time, you got to guess right twice, right? You got to be right on when to get out. You also got to be right on when to get back in. So again, we try to take a longer term perspective and develop plans for clients where we can stick to that plan, right, through those shorter term market swings. But going back to your mention of cognitive bias, that hits home for me, because I've worked as a therapist for many years, and I've got a couple of graduate degrees in clinical mental health counseling. So I like to kind of integrate these fields of study, and it certainly affects us as investors as well. But cognitive bias, we've all got, as humans, cognitive biases. We're not really wired we're not wired for disciplined investing. And there's all types of cognitive biases that affect investors, but you mentioned hindsight bias, and that's a big one. And hindsight bias is when we have a tendency to view past events as more predictable than they actually were. And that can really get us as investors, because we might go back and say, hey, and I've mentioned this one to you before, Richie. One that we hear a lot is, we should have known Apple was the place to invest,
No, it should have been
15
obvious.
years ago. I was working then, and really we didn't. It's hindsight bias that we've got all this data now that says, yeah, we should have known. No, we shouldn't have. Same thing with like the 2008 financial crisis. It took years of kind of post-mortem examination of that crisis to really fully understand what happened and why it affected market so much. We have a lot of people, and sometimes our tendency to think we should have seen that coming. No. Again,
I feel like I'm so guilty of this.
we all are.
Before really even seeing the phrase, I didn't understand what it was. As soon as I just looked at the definition, I was like, oh, I think I do this all the time.
Cognitive bias, it served a great role, certainly evolutionarily with humans.
Oh, that's interesting.
They're positives, right? And we look for, again, we might look as humans for certain patterns, right, that become mental shortcuts. Yeah. This type of trail always leads to game, or this type of trail always leads to water, or this leaf is always edible, right? Evolutionarily, those things are helpful, but again, in modern society, they're not always, and specifically with the market, we tend to look for patterns that maybe aren't there. Hindsight bias can get us down that path, so it's difficult. And so that's part of our job as investment advisors, is to help our clients avoid these thinking errors, which can then lead to behavioral mistakes. And really, you make a few mistakes in regards to the market and make some bad short-term decisions, it can really have a negative impact.
Wow. All right. So as an individual investor, what's sort of the best way for me to position myself in this current market?
Yeah. And again, here's what I would say. I'd like to broaden that out. And I would say, let's go from the current market and to an answer that would be important for any type of market, right? And what I would say is, control what you can control, right? And that's not what the market's going to do over the next 6 months. And so what you can control is to sit down and develop a plan that is a sensible plan based on your unique needs, your unique goals. Structure a portfolio that is going to take care of your short-term needs. So if you've got short-term needs, you're not putting those at risk, right? You've got a certain amount in very safe investments. And then for those assets that are investable, structure it in a way to capture those longer-term capital market returns that we've talked about. Diversify globally, and we can talk about more about what that means if you want. Manage your expenses and taxes. Those matter a lot in the long run, so watch out for expenses and taxes. And then most importantly, stay disciplined through these dips and swings, because the timing, it'd be great if it worked, but it just doesn't. You can't consistently do it over time. So you've got to develop a strategy where you're going to be okay if that next year is that worst, 1 in 40 years, that, hey, I can stomach that. I know that's the price of admission for these assets where I'm targeting longer term growth, and I'm going to be okay with that.
Well, you talked about investing globally. If you're an international investor, what are some opportunities or risks if you wanted to go down that road?
Yeah. So again, with our clients, and I encourage anybody that's looking into investing to diversify in lots of different ways, and one of those being to diversify globally, for a couple of reasons. One is it's a wider opportunity set, right? There's, you think about the large market as we know it in the US, it's the S&P 500. It's one company, there's one country, and it's 500 companies. If you think globally, we've got many markets and thousands of companies that are available for investment. And just think about it logically. If I want to put some money, if I want to invest some money in the auto industry, I might want to have a little Ford or General Motors, but I probably want to have some Toyota as well. If I want to invest in electronics and technology, probably I want to have a little Samsung. Everybody's got a Samsung TV. A lot of people have the phones. Let's get some money there. So it's just that broader opportunity set. And then secondly is that market leadership, and what I mean by that is are U.S. based domestic investments doing better, or are overseas investments doing better? That leadership tends to change over time. In times of crisis, like we've seen COVID and with world banks raising interest rates this year, so the last couple of drops, all stocks have kind of moved together. Everything's been down, but over time, what we see is a diversification benefit because they don't move perfectly together. And sometimes when U.S. stocks are zigging, overseas stocks are zagging,
Ah,
vice versa. And so you get a diversification benefit, and that leadership tends to change over time. And you see a period like the last 10 years, U.S. has done better than overseas stocks pretty consistently. The decade before that, international stocks tended to outperform. And then in the last 6 months, we've seen
oh, I
international
had no
stocks
idea
do
that was
a
true.
little bit better. Yeah. And so those patterns of kind of market leadership change, we know they're there. Again, there's something that's very difficult to predict. So we want to have reasonable exposure to both. We want to have some U.S. holdings and some international holdings so that we're getting the benefits of that diversification, and we're getting the growth regardless of which market it's coming from.
What do you think are what do you think could cause the current market trend, the rebound potentially to stall or reverse?
Um, that's another great question. There's still a lot of uncertainty out there, and we're not in the business of trying to make predictions. But what I will say is, if this, and we've seen this week, the market's pulled back, 1% or 2% from where it was last Thursday. But the market's still up, depending on what index you're looking at, whether a
Hmm.
US or global index, the market's up, 14 to 17% from its October low. So that recovery, if you want to call it that, is still got some traction. But could we reach new lows? Absolutely. Let's say the war in Ukraine escalates and something crazy happens there. There's a use of a tactical nuclear weapon. I mean, there's all kinds of one-offs that again are surprises, right? The market is really good at kind of pricing in all the known information and all of our kind of best bets about where we're going to go, right? And it's all of us coming together as investors and agreeing on fair prices at which to buy and sell securities. That's what sets the level of the market. So it's a pretty good information aggregator.
Ah, that's
Surprise, yeah.
interesting. And it
And
kind of
so
automatically adjusts itself with as the information flows in.
yeah, if I think, let's look at an individual stock. I might think it's worth X and you might think it's worth Y, right?
Yeah.
You and I, if we're buying and selling, have to come together and agree upon a fair price. One of the things I don't like about the media is you'll hear sometimes in some of their hyperbole, investors are dumping stocks, right? Investors are running from stocks.
Well, news is all hyperbole. That's the
Yeah,
only news I
well,
see on my feed.
keep that as a side note. Can we come back to that one, Richie? Because I want to talk about that.
Yeah.
But when they say investors are dumping stocks, that's not true, right? If I'm selling a stock, somebody else is buying it. So
Mm.
stocks in general aren't being dumped. It's just that we're coming to a lower agreed upon price. And so that's where we're determining that market value. And like uncertainty in the short run might bring those fair prices down, if you will.
Yes.
And so again, the market, everything we know right now, it's kind of priced into the market, right? But surprises, and certainly negative surprises, could bring us to a new bottom. Absolutely. um you hear some talk again about the debt ceiling right now, and we're
Hmm.
already
Of
in a
course.
period where we're taking extraordinary measures to kind of keep things going, but we're going to reach a point sometime between June and probably October where we truly run out of money to pay the bills. And at that point, the government, the last time this happened, we had a plan of how to prioritize payments,
Yeah.
but the markets would not like that, right? And so that would be a big risk that, if we don't come to an agreement prior to then, we'll probably see some additional downside. Again, I'm not a market prognosticator. I'm not a short-term predictor. I know what the market's going to do in the long run pretty confidently. I have no idea what it's going to do in the short run.
Yeah,
right?
so that's
And that's the
really
honest
why
answer, right?
trying to time the market, thinking on the short term, all these things are going to cause issues for you in the
Yeah,
future.
and
It's
it
just sort
can
of a mindset you have to take on to think as a long-term investor if you want to be successful. Would that be fair to say?
absolutely, absolutely, and it's kind of counterintuitive again to what you see out there, and this doesn't speak to hyperbole necessarily, but it speaks to what we see in the popular media. You know, whether we're talking about looking at articles online, or whether we're talking about social media and articles
Hmm.
that are shared, or popular media. You know, somebody being interviewed on TV. If I come on TV and I'm honest, and I tell, you know, I go on the Today Show and I tell the audience that they ask me what's the market going to do in the next month, and I tell the audience I have no idea, which is the honest answer,
Yeah.
and invite me back for the next show, right?
Yeah, it's
So
not going to get any
I want to
ratings.
keep being on TV. I've got to have a great story about why the market's going to be down or up, and here's how I know exactly why. That's just not the truth of it. But as investors, we're tempted to follow those, you know, and the louder they talk sometimes, the more we hear, and we're like, maybe what am I missing out on that everybody else knows here? So I'm going to do this or that in reaction to that. And so we always want to be proactive in our planning rather than reactive. And unfortunately, a lot of TV is kind of reactive type thinking.
Well, yeah, I mean, it really is what gets ratings. If you look, just looking at my Google News feed it's the worst, the best, the biggest, the smallest. It's just the far end of every spectrum. That's just the words that are used because that's what gets
Yeah,
clicks. And
and I'll go back to your Richie. I love that you brought that up, and I just wrote a blog post recently, and I think I titled it "Headline Hyperbole."
great.
It,
We'll
it
link.
addresses exactly that, because, and it's a real issue and one that's important to me too, because and again, this is the kind of media in general. I'm not a media basher. It's important, right? It's where we get our information and our news, and it's important to be able to trust some media sources. But it seems like there's been a trend in the last many years across the spectrum, whether you're talking about, you know, more conservative leaning media, more liberal meaning, and everything in between, that everything is all the headlines are hyperbole, right? It's like, you know, the markets don't rise or fall anymore. They skyrocket, or they plunge and they plummet, right? Like, you know, and that type, and everything is unprecedented. And, you know, I've seen winter storms over the last week, and then every storm is massive, right? It's all these words that are meant to grab our attention. And they cause real, like, anxiety for people, you know,
There's no
and
doubt.
it actually has a real effect. And there's a Nobel Prize winning economist, Daniel Kahneman, who he's an author, economist, and research, and he's won the Nobel Prize. And
Yeah.
he did a lot of research and writing about basically how our brains work, and how our brains process information. And basically what he looked at, it was pretty cool. We got, think of it as two areas of the brain, right? Our system
Hmm.
one processing system, or system one brain, that is, it's basically making snap assessments. It's making instantaneous assessments of situations, and it's tied very closely. It's in the amygdala and tied very closely to the emotional processing center of our brain. So
Okay.
think of it as the emotional reactive part of our brain. And then there's the system two processing system, which is the slower, more reflective, you
Mm.
know, the part of our brain that's going to help us make good decisions,
Yes.
and considering all the inputs and decisions going forward. It seems like the media is almost exclusively focused on triggering that system one part of our brains again, which causes bad
Mm.
decisions, and it causes emotional reactive, and a lot of times emotionally reactive decisions, and a lot of times emotional stress and pain, which is unfortunate. And so I think, you know, that's just something we live with right now, but something we help our clients with, and something I would encourage anyone who's watching this is, you know, sometimes turn that off, and learn how to, you know, sift through or even tune out the noise at times, and learn how to kind of take the news for what it is, and kind of peel off that hyperbolic layer that seems to be on everything.
Absolutely.
Yeah.
Well, Bart, I think that's a good way to end this because that piece of advice could help everyone in more than just investing.
Yeah, absolutely. That goes way beyond investments. That's just for all
All right.
our daily well-being.
Absolutely.
Yeah.
To you, and we'll be talking again soon.
Yeah, I appreciate the chance to speak with you, and we'll talk soon.